So that was the business roundup for today. Now to the very first story of the day. An IMF mission is to visit Ghana in the course of the week for a possible third review of the fund program signed with the country. The IMF expressed satisfaction in its second review in January and approved $114 million for Ghana. As part of the visit, the institution will expect government to stabilize some macroeconomic indicators while it works on cutting down on the central bank's financing of the budget deficit. It will also be concerned with excessive government expenditure in an election year. While these concerns are prevalent, economist and head of finance at the University of Business School, Professor Godfred Bokpin, is expecting the IMF to be firm on Ghana's fund program to ensure that the central bank does not oversee any excessive expenditure. He spoke to Joy Business.
Ghana's third review under the IMF program commences this week, and we're here to find out the possible outcome of this review. And here with me is Professor Bokpin. He is the head of finance here at the University of Ghana Business School. Hello, sir.
Yes, good morning.
Good morning.
Now, my issue is that Moody's downgraded us, and then Fitch on just their January grading of Ghana maintained us with a B with a negative outlook. And then we also have inflation up by 0.07%. I don't know, from where you sit, what do you think the impact of this review or the possible outcome of this review will be?
Yeah, largely I'm expecting that they will pass us. Not that would have met all the requirements, the continuous and quantitative or structural reforms that are contained in the program. But my understanding is that we have not done poorly along all the indicators. I mean, we have made some progress in terms of the physical outturn. For instance, if you look at our debt to our fiscal deficit, that is moderating, is coming down. We can also look at the primary balance, which is also taking shape. We can look at the wage bill, which has come to about 44.4% or so, even though the wage bill as it stands now is low, but it doesn't reflect the reality because of the net freeze on the employment. The fact that our public sector is actually not recruiting, so that may not be a true reflection of the actual situation, because when they lift that embargo, we come back to ourselves, and that could also head up to some extent. That said, there are other key program objectives, that we have not been able to meet. And I want to believe that this time around the IMF will be a little bit tough and drive home the need to do something about those things, not only in terms of monetary policy tightening to contain the threat of inflation, but really, how do we grow the real sector also to ensure that at the end of the day, we do not sacrifice growth necessarily just to achieve certain targets. So inflation still remains quite highly elevated relative to the program objectives. When you also look at, of course, that would also influence interest rate, even though we are seeing some downward trend when it comes to interest rate. And we see a divergence there between the policy rate itself, the interbank rate, and then the 91-day bill yield, which in itself is not. So some kind of alignment would have to be done going forward. If you also look at the program actually envisaged that our debt to GDP ratio would come down, but that hasn't happened. I want to believe that it's not necessarily the creation of the IMF program, is because the implementation period coincided with certain inherent challenges in the economy, like electricity strategies that actually affected the real sector of the economy. Consistent with fiscal consolidation also, we expect that in the near term or in the short term, growth will have to give up to be able to absorb the painful physical adjustment process that the economy will have to go through in order to correct those imbalances. So those ones were expected. Again, if you look at our, in terms of debt affordability, I do agree with the rating agencies that that is quite not sustainable. It's not in the best interest of Ghana. We are spending more than a third of our tax revenue just to service our debt, and that itself is not good. The latest debt sustainability that the IMF did together with the World Bank do suggest that we are not doing badly at all when it comes to the indicators of those debt sustainability. But when it comes to the debt service to revenue ratio, we are way above the policy dependency threshold, whilst the other indicators, we are below the policy dependency threshold, which is good for us. But there's also something that we have to be mindful of, which is the bullet feature of the Euro bonds, such that if we consider those ones, then it means that we may not measure up well even in the other indicators of debt sustainability. So we have to be quite mindful and make sure that the debt management strategy that we are putting in place, we actually keep to its implementation, because there's one thing having a strategy, there's another thing also translating that strategy into actuals, and that is where we don't do well as a country. We've got beautiful strategies, development strategy, whatever, and all of that, but really when it comes to implementation, I mean, we are dwarfed because we are unable to walk our talk and talk our walk, and that's a real issue. So these are things that we have to also bear in mind. Beyond that, we also have to take into consideration the swap arrangement that the central bank is also doing as a way of also managing the cedi. I mean, if you look at the fact that the IMF switches to the residency approach to debt valuation rather than the currency approach, it has implications, because that swap arrangement will also be included in our public debt, and that may also expose us in terms of our debt sustainability outlook. These are things that we have to bear in mind. I think that the third review for me is very critical. And at this stage, I would urge the IMF to go beyond being diplomatic. And we have to be able to say things as they are and drive home the need for government to actually act a little bit swift, even in terms of passing certain reforms that are in the IMF program, because the gains that we are seeing at the macro level, to be able to ensure that they are durable and lasting, we have to situate them within broader institutional reforms. And these reforms are still behind. You know, so, I mean, what is keeping us? The right to information bill, the other things, because you see, growth, development is such that you have to look at it holistically and ensure that whatever gains that we are able to record, of course, is coming at a cost to all of us. You see what the economy has gone through, energy sector levies, adjustment here and there. We have to make sure that we lay the right foundation, that we don't go through this again. Then we'll be able to anchor our transformational agenda when we are able to guarantee ourselves macroeconomic stability, which is not an end in itself, but it's a requisite. I mean, it's a requirement for transformation. So that is the way we have to look at it. My understanding is that at the end of the day, as we say, you don't need to score 100 to say you have passed. But I want to believe that where we wouldn't have done well, I also expect the fund to highlight that and also offer suggestions as to how to address them, because and I also do expect that the fund will actually be tough. I'm sure they will certainly have a meeting with the central bank and expect that because the central bank has got a role to play in fiscal discipline. Yeah, I mean, the kind of accommodative monetary policy that we have seen in election years, I think that we have to grow up and ensure that that doesn't happen again. If we do that, then politicians will have the laxity of actually spending beyond what is actually planned. The real effect of fiscal discipline is that if politicians want to spend in excess of what has been budgeted, then they will learn to put their own hands in their own pocket rather than the public pocket.
And especially with the new governor in place, under the law, we are the review program, we are not supposed to lend more than 10% of our reserves to government.
The program is supposed to be zero.
All right. Now we are looking at the new governor. Are they going to look at whether he's going to be fiscally disciplined in order not to lend? Because we are in an election here anyway.
Yeah, it's up to the new governor. What does he want to be remembered for? So those are the issues. But we also have to bear in mind that we didn't have market confidence. It was one of the reasons why we had to submit ourselves to the IMF for this program. So we don't want to do anything that will send us back, okay, because the market is watching. Okay, investors are watching, and you also have to remember that elections have implications even for stock markets, even for foreign direct investment and all of that. And I want to believe that, I'm not a political scientist, but I want to believe that there has to be a clear timetable about how this election will be conducted. As an economist, I feel concerned once in a while because there is some level of uncertainty as to how the 2016 election will be done. And I think the EC would have to put its feet down and ensure that there's some level of trust and confidence that we are able to go through this election with some kind of certainty and clarity in the minds of everybody, not only Ghanaians, but even our donor partners and all of that, because it has implication, because we do interact with investors here and there, our clients outside, and they are concerned. And various election watchers or NGOs or civil society in that industry that may not have that political affiliation are equally raising concern. So I think one thing that is important in economic governance is predictability. Okay, policy predictability is good for market confidence. It's good for attracting foreign direct investment. It's also good for even mobilizing and retaining domestic investment, because Ghanaians equally are exiting their capital. So we have to look at it both ways.
I've had most people saying that, or a few people saying that it's not possible for us to overspend in this election year because we are under the IMF program. Do you share the same opinion?
I to some extent, fine, the IMF program is on, but I think that a lot depends on us. We can set it aside if we want to. What would the IMF do? They will not promote a regime change. You understand that? You can even see that we are unable to meet some of the program objectives. But what is the IMF saying? You understand that? So let's not stop doing what we have to do and the kind of accountability we need to demand from our own leaders and think that the IMF is just here to do that for us. I mean, after their review, they will be gone. We are here. So I want to believe that the IMF itself has also highlighted the election as one of the threats to the program itself. So it means that they are equally concerned. I want to believe that our donor partners, development partners are equally concerned. Ghanaians are equally concerned. So what is important now is to make sure that we all do our part. I want to believe that the president is committed to it when he says that this year we will not overspend. But we cannot take that good intention, we cannot mistake that for accomplishment, because we have heard that before in 2012, 2008, 2000, and all of that. In 2004, it wasn't that bad, but 2000, 2008, and 2012 was a year of its own. We had these promises, I mean, but we couldn't live up to it. So so it's good that we are getting this kind of compliment from the IMF, but I want to believe that it's not an end in itself, and that is not to substitute for what we are supposed to do, civil society, I mean, all of the media, what we are supposed to do in ensuring that there's some level of physical or discipline, because we all have a role to play. I mean, we ask the right questions and we push for it. Ideally, politicians won't be happy, but this is not a comfort zone either for anyone, because when the physical slippages come, we all go through that painful adjustment. Unfortunately, that cost is not shared evenly. Okay, you get a poor absorbing majority of them, and those who actually benefited from that don't even pay the right price to have it corrected.
All right, so that was Head of Finance of the University of Ghana Business School, Professor Godfred Bokpin, sharing his thoughts on the third IMF review, which is expected shortly in the course of this week as the IMF team arrives in the country. It's now time to take a look at developments on the stock market, and I've been joined as usual by Bertha Atubiga to give us the details. Hi, Bertha. Good evening.
Hello.
All right. So how was it on Friday?
Let me say last week on the stock market was not very positive. The market has been in its bearish state for some time now. The major indices actually dipped further into the negative regions. We saw the composite closing at negative 5.33%, and then the financial stock index went to negative 7.02%. So when you compare it to the previous week, there was a further dip of 0.87% and then 1.18% respectively for these major indices on the exchange. Now the worth of the exchange, that's the market cap, also went down by 95.10 million Ghana cedis. This is quite higher than what we saw last 2 weeks. Last 2 weeks, we saw about 19 million drop in the with the worth of the exchange. but last week it went down by 95.10 million Ghana cedis. And we saw the worth of the Ghana Stock Exchange closing the week at 54,676.54 million Ghana cedis as compared to the previous week, where it closed at 54,771.64 million Ghana cedis. And when you look at the total worth of equities that actually exchanged hands or traded on the market, it went down by 38.83%, and we saw over 1.4 million shares trading, and that was because we saw a block trade in Unilever last week, and that actually resulted in the higher volumes that we saw, but still lower than what we saw in the previous week. And the worth of the equities that traded was at 9.9 million Ghana cedis, and that also went down by 31.85% as compared to the previous week. So we say last week was actually still depicting what the market is right now. It's still in its very state, and we're expecting that to continue. And when you look at the equities that even gained and lost on the market, you realize that we had more equities gaining as compared to equities losing as compared to the gainers. That's why the worth of the exchange actually went down. But these are not very, very large market cap equities, though we have some big guys there like GCB and then EBG. We didn't see the weight of the market actually coming down significantly as we would have seen if equities such as ETI or even Standard Chartered Bank had lost last week on the exchange.
So it looks like the financial equities are still not doing well, because last week we saw, some of them also declining in value. And
I think it's taking a trend that we saw in 2011. In 2011, that was what we were seeing. The financial stock index was actually following, or let's say the composite index was doing better than the financial stock index in terms of the negative year-to-dates that we are recording. 2011, we saw the same thing. But in 2013, they all recorded positive returns. But the average performance of the CI was higher than the composite index. But when you look at the financial stock index, for instance, last week I made mention of the point that one thing that affected most of them is the fact that their NPL actually went up. Not all of them, but some of them had their NPL, that's the non-performing loans, actually going up. And all these equities, not only the financial equities, were exposed to what was happening in the economy, where we had this situation with our energy crisis. Operation costs for most manufacturing companies went up. You look at cost of production or cost of doing business, even for the financial operation, everything went up because they had to get extra, let's say, alternative sources of power. Right. And then you remember last year, our cedi was not doing very well. So most of these equities were also exposed to some currency risks. Inflation was also on the high, though it was stable in the last quarter of the year. These equities were exposed to this risk as well. That's the inflation risks as well.
Well, now, better, let's look at the commodities. Yesterday in Doha, Qatar, Iran refused to join the OPEC member countries who were seeking to place a cap on the oil outputs. Now, this has virtually translated into oil prices, because largely this afternoon it dipped again. What's the situation so far?
Well, it's simple. The demand still, the supply still outweighs the demand. It's like a lot of producers or a lot of suppliers being in the market, and they want to get their their consumers. So if it is just as simple as demand and supply. When supply outweighs demand, definitely the price will go down, because the one who is demanding for the product has a higher bargaining power as compared to the supplier, because you want to get your products off your stock, you want to get your stocks into the market, and then you have no alternative than to reduce the price. So that is one major thing that we saw with commodities. And if this is going to happen, it means that we should expect further drops in the price of crude oil, though it is not going to reflect in our market, that's the Ghanaian economy, because we have some tax elements imposed in the product of petroleum products. We are not going to benefit that much, because prices of crude oil went down from over $100 per barrel to around 30, even below 30, but we haven't actually benefited from that low prices that we have, though we also export. Ghana export, but it is not in that large quantities like you can have in Iran, Saudi Arabia, and even Nigeria. You can't compare that to Nigeria, but yet we are not.
But not talking about gold and cocoa.
Last week we saw gold actually going down. It's dipped. by some marginal percentage, and we saw cocoa also showing up on the, like when you look at the weekly change, cocoa actually went up, and we saw it closing at $2,988, and that is quite, I think it is on the positive side when we see prices of our exporting products, that especially for cocoa, on the world market, moving up or adding up value on, let's say, weekly basis. It is quite positive because it's lost about 2 points. I think last week, it lost about 2% last 2 weeks, and it was able to gain more than that this week, and that is quite exciting and then positive. Yeah.
So, what is the expectation this week?
This week, even before I go to what we are expecting this week, let me quickly take our viewers through the equities that's lost. I talked about the Guinness. The Guinness was just Gore and Aluworks. They added Aluworks added 2 pesos. That's 28.57%. Let me explain this as well. You see, when we have low-priced equities, for instance, Aluworks, you see SIC, when there's a price change for like 1 peso, 2 peso, you see that the percentage change is quite huge because it consists, like, the weight of this change is not significant on its market cap is quite lesser than the large market cap equities. For instance, ETI loses a peso or two, and you see it dropping about 30%, 20%, 15, 14% of its previous week value. But when we see these low-priced equities, we see relatively a higher percentage of the market cap losing on the market or gaining on the market. And then we look at the losers. Gore Aluworks gained last week by 2 pesos and 1. Gore gained a peso. It closed at 1 CD 46 pesos, and then Aluworks closed at 9 pesos per share. But Aluworks has actually lost 35.71% of its share value since the year opened, and then Gore is trading at has returned 4.29%. That's positive returns to investors as compared to Total, which is still in the negative regions. Now, for the losers, we saw SIC closing last week at its year open value. It started the year at 14 pesos per share, and it closed at 13 pesos. It closed at 14 pesos. That's 70.65% loss. And then we saw GCB, that's formerly Ghana Commercial Bank, which is now GCB, losing 14 pesos. And it's closed at 3 cities, 50 pesos per share. We saw the third one being Unilever. Unilever lost 2.30%, and that was because we had a block trade in Unilever, which was traded at a discount, so the price was brought down, and then we saw that reflecting on the market as well.
So quickly take us through the currencies before we round up.
Last week we saw the cedi gaining marginally to the dollar and then the pound. To the dollar and euro, but it's lost to the pound. And if you look at the Gold Coast Cedi Index, that measures the average performance of all the listed equities, it records a year-to-date depreciation of 1.84% year-to-date. And then on a weekly basis, there was an average gain of 1.34% against these major trading partners on the interbank market.
All right, thank you very much,
You're
Bertha,
welcome,
for that update. Bertha Atubiga, our stock market analyst, bringing up to date with the issues with the stock market values and the performance of the currencies, commodities, and so on the stock market. And on that note, we wrap up this evening's edition of Business Live that came to you right here from our studios in Accra. My name is Emmanuel Abuaji-Riafe. Join us again, same time next week for another interesting edition. Up next is Focus on Africa.